trying to wrap your head around financial regulations, especially in this globalized world we live in, can sometimes feel like, well, like trying to solve a Rubik's Cube blindfolded, wouldn't you agree?
Oh, absolutely. It gets even trickier when you zoom in, on a specific sector in just one country.
Yeah.
What's really interesting, though, is how these local tweaks often stem from bigger international shifts or just the practical headaches of applying global rules locally.
And that's exactly where we're headed today. We're doing a deep dive into a recent update, specifically about how risk-free interest rates are calculated for the Nepali insurance sector.
Right.
Now, for you, the learner listening in,
Yeah.
our mission today is pretty straightforward. We want to unpack why this technical-sounding update actually matters, what the key changes really are, and what they mean, without getting totally lost in the jargon.
Yeah, cut through the noise.
Think of this as your shortcut to getting a handle on a very specific but still important piece of the Nepali financial puzzle.
And it is important. I mean, when you step back, having a reliable, transparent way to figure out these risk-free rates, that's fundamental for a healthy insurance industry.
Absolutely.
It's the bedrock for valuing liabilities, figuring out if insurers are actually sound.
Couldn't agree more. So, to guide us, we've got two key documents in front of us. First, there's the NIAR Nepal Methodology Amendment.pdf. This one's dated Bishak 16, 2081. That's April 29, 2025 for most of us.
Right.
And we'll also be looking back at the original methodology document, Risk-Free Rate Term Structure, IFR, Nepal Methodology.pdf, which was approved back on December 11, 2023.
Got it.
So maybe let's start by laying the groundwork. Looking at that original 2023 document, why did Nepal need its own specific method for calculating these rates in the first place? What was the issue?
Well, that really gets to the heart of the Nepali financial market itself. The 2023 document is pretty clear on this. Nepal just doesn't have what we call a deep, liquid, and transparent fixed income market. Meaning, essentially, there isn't a reliable set of market-based interest rates on very low-risk assets inside Nepal that you can just point to and use directly.
Okay, that makes sense. So if you can't find good signals at home, you have to look outside.
Exactly.
And the original methodology, the 2023 one, it used a three-step process, right? Can you walk us through those?
Sure. So step one was to use the liquid part, the actively traded part of the Indian risk-free interest rate curves. They got this data from a recognized international source, initially planning to use EIOPA, the European Insurance Authority.
Okay, start with India. Then,
Step two was to adjust that Indian base rate, tweak it to better reflect the specific economic conditions in Nepal.
right, we make it relevant.
And the third step was extrapolation, basically estimating rates for longer time horizons beyond where that liquid Indian data stopped.
And using the Indian curve as the starting point, a big reason for that was the currency peg, wasn't it? The Nepali rupee being pegged to the Indian rupee.
Precisely. That stable exchange rate peg provides a very solid justification. The 2023 document even mentions Nepal's central bank has a long track record of managing this peg effectively. It suggests a strong financial link.
Okay. Now, I remember reading they considered adjusting for inflation differences between India and Nepal, but decided against it. Why was that?
That's right, they did think about it.
Yeah.
But they opted out for a few reasons. First, they figured short-term inflation blips aren't that relevant for medium to long-term rates.
Uh-huh.
Second, they worried using long-term inflation targets might just add unnecessary volatility, make the rates jump around too much.
I see.
And finally, using historical inflation data, it might not react fast enough to what's actually happening in the market now.
Interesting. Okay, so no inflation adjustment. How did they adjust the Indian curve then? This feels like a crucial part.
It is. The initial adjustment looked at the average difference, the spread between Indian rates and rates in 5 other economies: China, Hong Kong, Malaysia, Thailand, and the US.
Okay, a comparison group.
Yeah. And for each time period, each tenor, they'd look at those 5 spreads, throw out the biggest outlier, the one furthest from zero,
Got it.
and then take a fraction, initially 20%, they called it the P factor of the average of the remaining 4 spreads. That fraction was the adjustment applied to the Indian rate.
Okay, so it's like using this group of peers to get a sense of the broader context, and then using just a piece of that difference to nudge the Indian rate towards something more Nepali specific. And wasn't there a limit on this adjustment?
Yes, absolutely. To stop the Nepali rates drifting too far from India's, they put a cap on it, 75 basis points, in absolute terms, like a safety rail.
Makes sense. And what about short-term wobbles, sudden spikes? Did the original method have something for that, the STVA?
It did. The short-term volatility adjustment, STVA, That was designed to smooth out any sort of sudden jumps in the calculated rates. It basically compared the latest calculated rate with the previous one.
Okay.
If there was a big leap, the STVA could kind of dampen that move.
Right. And lastly, because that easily observable Indian data only went out to 5 years initially, they needed a way to guess, well, estimate the rates further out. That's the extrapolation bit.
Exactly. For that, the original method used the Smith-Wilson technique. It started extrapolating from year 6 onwards. They set a convergence point way out at 30 years, and a target long-term forward rate, the LTFR, or UFR, which started at 5.50% and was planned to gradually decrease over time.
Okay.
It's a way to mathematically smooth the curve out towards a stable long-term rate.
Right, okay. So that gives us a pretty clear picture of the original 2023 setup. Now let's shift gear to the 2025 amendment. What actually triggered the need for these changes?
The main driver, and the 2025 document is very upfront about this, was EIOPA deciding to stop providing some essential data. Specifically, from January 2025, EIOPA wasn't publishing the risk-free curves for India, Malaysia, and Thailand anymore, and those were, key inputs.
So fundamentally a data availability problem. Your main supplier stops stocking the key ingredients. You have to find a new supplier.
Pretty much, yeah. And the solution they went for was to move to a single data provider for all 6 of those reference countries.
All 6. So India, China, Hong Kong, Malaysia, Thailand, and the U.S.
Exactly. To keep things simple and methodologically consistent, they decided one vendor for all 6. And that vendor is Refinitiv. The amendment even lists the specific codes, the RACs, for each country and maturity from 1 year out to 10 years.
And why Refinitiv specifically do they shop around?
Interestingly, no. The Nepal Insurance Authority, the NIA, explicitly said they didn't do a big independent search. Instead, they decided to align with what other regulators with similar needs were doing.
Okay.
They chose the same provider that EIOPA itself uses for the risk-free rate calculations it still does. The thinking was, continuity plus leveraging EIOPA's experience in vetting data providers.
Okay, that makes a certain kind of sense. Align with a known entity. So the big takeaway is a switch to a more unified, hopefully stable data source.
That's the core of it.
Now, besides the data provider switch, there were a couple of other key changes in the 2025 amendment too, right?
Yes, 2 other significant ones. They extended the liquid part of the yield curve they consider, and they got rid of that short-term volatility adjustment, the STVA.
Okay, let's take the liquid part extension first. The old method used 1 to 5 year data. What's the new range?
The amendment stretches that out to 1 to 10 years, assuming the data is available for each of the 6 countries, of course.
And the reason for stretching it out?
The main goal was to reduce how much they have to rely on that extrapolation, that mathematical estimation for longer terms.
More real data, less guesswork.
Exactly. By using more observable market data for longer maturities, they hope to minimize differences between the official Nepali RFR curves and the market info insurers themselves are using.
That sounds like a good move, generally relying more on actual market signals. But the amendment document does add a little warning about liquidity for those longer terms.
It does, yeah. It's a bit of realism. While having more data points is good, the NIA acknowledges that trading activity liquidity might be thinner for those longer maturities, even in these big markets.
So it's a trade-off.
It's a balancing act, definitely. More data versus potentially slightly less reliable pricing way out there.
Okay. And the other big change, getting rid of the STVA, why did that go? It seemed to have a purpose before.
Yeah, its removal was mainly down to an improvement in data timing. Remember how we said the original method used data from the end of the Gregorian calendar month?
It was about 15 days off the Nepali month end.
Right. And that timing mismatch, that potential for volatility between the 2 reference points, was why the STVA was put in place.
I see. So the STVA was basically a patch for that calendar misalignment.
Pretty much. And the good news is, from January 2025, they found they could get data inputs that line up exactly with the end of the Nepali calendar month.
Problem solved.
Exactly. No more calendar overlap issues, so no more need for the STVA patch. Plus, the NIA mentioned it was rarely triggered anyway, and removing it actually helps align the official RFR info better with the data insurers use, and it lets them publish the rates about 15 days sooner.
So faster, more aligned data for insurers. That seems like a definite plus.
Yeah, it streamlines things.
So, okay, even with these changes, new data source, longer liquid part, no STVA, the basic 3-step idea. International curves, adjust for Nepal, extrapolate. That core structure is still there.
That's absolutely key to understand, yes. The amendments are really about adapting to data changes and refining the mechanics, but the underlying logic hasn't been thrown out. It endures.
Okay, good. So how does the updated methodology actually play out now, step by step, with these changes baked in?
All right, the 2025 document lays out 5 steps for the amended process. Step 1, as we've said, is getting the risk-free curves 1 to 10-year maturities for the 6 reference countries from Refinitiv using those specific RAC codes.
Okay, get the raw data. Step 2.
Step 2 is deriving the zero coupon spot risk-free rate curves for that liquid 1 to 10-year part. Basically, most bond data comes with coupons, so you need to mathematically convert it to an equivalent zero coupon rate for easier comparison.
Right.
They also fill in any gaps if a particular maturity is missing within that 1 to 10 range using interpolation. And for both converting to zero coupon and interpolating, they're still using that Smith-Wilson method.
Okay.
For this specific step, they also set some technical parameters like treating the last observable term, or LOT, as 10 years, convergence at 30, and setting the LTFR based on the last observable forward rate. But that LTFR setting here is more technical plumbing, doesn't massively affect the final rates.
Got it. So clean up the raw data, get it into a standard zero coupon format. Step 3.
Step 3 is that crucial adjustment for the Nepali economy. This still uses the same basic idea as before. Take the Indian rate, adjust it by that 20% p-factor of the average spread against the other 5 countries, minus the outlier. The main difference is this adjustment now happens across the full 1 to 10-year range, not just 1 to 5, and that 75 basis point cap on the adjustment. Still there.
Okay, same logic, wider application.
Exactly. The document even gives the specific formulas for positive or negative spreads and shows a comparison table demonstrating a smooth handover from the old method.
All right. So after the adjustment, step 4 must be the extrapolation for terms beyond 10 years.
You got it. Step 4 is extrapolating the curve from year 11 onwards. Again, they're using the Smith-Wilson method. Key parameters here. It's a zero coupon spot curve type. The last observable term, LOT, is now 10 years. Convergence is still at 30 years, so a 20-year convergence period. And that LTFR-UFR path is the same one as before.
The one starting at 5.5 veta% and stepping down.
That's the one. Starting at 5.50% in Nepali year 2080-81, dropping 10 basis points a year to hit 5.00% in 2085-86, with smooth monthly steps in between. And importantly, they're still using the EIOPA Excel tool to actually perform this extrapolation calculation.
Okay, complex math. But the goal is a reasonable estimate for those really long-term rates. And the last step, step 5.
Step 5 is simply the ongoing public disclosure. The NIA commits to publishing these calculated Nepali risk-free rates every quarter following the Nepali calendar.
Okay, that maps out the updated rate calculation clearly. Now, the amendment also talks quite a bit about admissible spreads. What are these used for?
Think of these as, like, pre-approved adjustments for valuing certain types of assets held by insurers. They come into play specifically for assets that pay out predictable cash flows in Nepali rupees, but don't have a reliable active market price.
So if you can't just look up the price on a screen,
then you might be allowed to use these admissible spreads in a mark-to-model valuation. It's a way to estimate value. But big caveat, if a reliable market price does exist, insurers have to use that. This is only for the illiquid stuff.
okay. And how are these spreads themselves calculated? Where do they come from?
Right, so the non-stressed versions of these spreads are calculated by taking a multiple of the average fundamental spreads published by EIOPA for China.
China again. Interesting.
Yes, specifically using the 1 to 10-year data from EIOP's PD2 sheet. And these Nepali spreads are based on the latest EIOPA publication, which usually comes out about 15 days before the Nepali month end.
So another instance of leveraging international data, EIOPA's assessment of Chinese credit risk, to create a benchmark for valuing certain Nepali assets where local data is scarce.
Pretty much. And those multipliers they use to scale the Chinese spreads, they're specific.
How so?
They differ depending on whether the asset issuer is a financial company or a non-financial one, and also based on its credit quality rating. The relevant average Chinese spread gets multiplied, and that resulting Nepali spread is applied to all the cash flows of that particular asset.
Okay.
The amendment gives the actual multiplier values and, importantly, puts a floor of 1.00 on them, so Nepali spreads can't be lower than the equivalent Chinese ones unless there's a really good reason.
Right. And these are the non-stressed ones. You mentioned stressed spreads, too. What's their purpose?
The stress spreads are used specifically for calculating capital requirements, the buffers insurers need to hold against potential losses.
Ah, for solvency calculations.
Exactly. They're calculated by taking the non-stress spread and adjusting it up or down by 30%. That 30% range aligns with the risk-based capital rules for potential adverse movements. The NIA will publish these indicible spreads regularly too.
And the document gives examples of applying these stress spreads, right, to see the impact on asset values.
It does, yeah. It shows how it works for a simple single-payment asset and a more complex multi-payment one. It's all about building in that prudential buffer for potential negative swings in credit quality.
Makes sense. Insurers can weather some storms. Now, wrapping up, the amendment had some additional remarks. Any key takeaways there?
Yeah, a few good reminders. First, they reiterate that these calculated risk-free curves won't just sit at, say, 6%. They will move with the market data they're based on.
Good point. Not static.
Second, because of that adjustment mechanism, changes in the Indian curve won't necessarily flow through one-for-one to the Nepali curve. There's a buffer or filter there.
Okay.
They also state that the adjustment factor, that P 0.20, is considered to implicitly cover currency risk, so they don't feel a need for a separate explicit currency risk charge on top.
Interesting. And they also acknowledge limitations, right? Given Nepal's market is still developing.
Yes, very clearly. They recognize the current market constraints and state that the methodology might need further evolution as the market matures. They stress the importance of ongoing monitoring and keeping the conversation going with the insurance industry.
Uh-huh.
And they circle back to the core aims. Provide a reliable picture of interest rate risk, be based on real data, avoid artificial fixes, and be stable and traceable.
And it all seems to tie back to that bigger picture mentioned in both documents. Nepal moving towards a more risk-based capital framework for insurance. This RFR methodology is clearly a vital piece of that.
Absolutely. It's a foundational element for building that more sophisticated, risk-sensitive regulatory system. It's going to impact how insurers think about their solvency, their assets, their liabilities.
Okay, let's boil it down. For you, the learner, what's the core message we've unpacked from these, let's be honest, pretty technical documents?
I think the main takeaway is this. The recipe for calculating risk-free rates for Nepali insurers has been updated. Why? Primarily because the main data source, EIOPA, stopped providing some key ingredients.
Right.
That forced a switch to a new supplier, Refinitiv. This change also allowed them to use market data for longer terms out to 10 years now and ditch-an-old volatility patch, the STVA, because the new data lines up better time-wise.
So essentially adapting to data changes to create a more current, hopefully more stable base for valuing insurance promises in Nepal.
Yeah.
It really underlines how connected global financial data is, but also how it needs local tailoring.
Exactly. It shows financial regulation evolving in real time to meet practical challenges.
And that leads us to a final thought, something for you, the learner, to mull over. Given these changes to risk-free rates and this wider shift to risk-based capital, who might this eventually influence the types of insurance products we see being offered in Nepal down the line? And what does this whole process tell us about the growing sophistication of Nepal's financial regulators as they work to align more closely with international standards?
Yeah, definitely food for thought. How does the plumbing affect what gets built on top?
Indeed. If you want to dig deeper into this stuff, we definitely recommend checking out the websites for the Nepal Insurance Authority, the NIA, and also international bodies like EIOPA.
Yeah.
Lots of info there on risk-based capital and how these rates fit into the bigger picture.
Absolutely.
Well, thanks for joining us on this deep dive.